Oh no, the Fed raises 0.75. It's a whatever catastrophe or something. I'm gonna do a big deep dive in this video on the interest rates, like what actually controls them, how the market responds to them. Uh, this is gonna be cool, but first I want to cover some divergences, looking at the RSI versus the market, right, and versus a couple other indicators. So yeah, please hit the like button for me and hit me up in the comments. And yeah, smash subscribe if you want to get some more of these videos. But I guess first let's do, I mean, this was my bottoming call here, which is clearly wrong now, right? I don't know about that. Let's go look at the sectors that are strong, and all the stocks I've been looking at actually bottomed the first time. Check it out. So Tesla, I don't know, it's more of an indicator, I think, than a stock itself. It's sort of a market leading indicator, but this was first bottom, right? Second bottom. So we did a double tap, and I called the first tap. So Tesla so far has bottomed on the second tap, and you can see GameStop has done 3 higher highs, pretty volatile, and holding up here, right? This is one of my favorite stocks. I have a pretty aggressive long position here. AMC, 3 higher highs. I have pretty aggressive long position right here. Senseonics I bailed on a while ago, but we're coming into support again. The first stab was the low, also on this. This is a highly volatile chart. It has not broken out yet, but I think this one, if it does break out right now, could rip. I'm pretty interested in this, but I'm not holding it right now. Workhorse, 3 higher highs, one of my stocks that I'm holding, and it's in the NASDAQ. So I don't know if the NASDAQ is going to be good or not, but it looks like it might have some juice. Aqua Metals, I just pulled this one up because it had a little ripper today, which is interesting. But this is second tap was the low here. But you can see all of these charts that I've been looking at did bottom the first time. Fuel cell bottomed first one, but I pulled back here. Less of a fan of this after that move. TCAT, yeah, the first bottom barely is holding. Oh, Redbox is not one of the ones I'm looking at, but this is just like the nonsense short squeeze thing that's been happening like the past couple of weeks. If it'll load it, it might not. Okay, yeah. So this thing, the March rally, like this thing's just been running. But in any case, I think we are picking up an actual bull trend on this thing. We broke a big downtrend. We're running. I don't know how high this will run, but I'm not doing a video on this right now. But you can see this wobbling across, trying to find the trend line, and then you get the jump on top. And now I think we're on top of it. So I think if we pull down into the trend line again here, especially above this $9 area, I think we could get a blast. And this is, another kind of nonsense stock like GameStop did last year, but um, it's actually pretty interesting. It's like the only thing running right now while everyone's terrified. Right, so let's go back now that I've shown that this lower low, I don't actually know what crapped out so hard to pull the whole market down there. But I mean, we just saw a bunch of leading stocks in the NASDAQ made their lows back here. And then other sectors, oh, the other thing that I just bought was AG. Let me look at that real quick. Um, silver miners, which made a low the first time, and it's pulled back. But this is a maybe a big bull flag, but it's coming into support here, and I think this thing could run. So I just loaded up on a little bit of this. Anyway, that's where I'm positioned right now. 100% long, 100% long, and I bought on all 3 bottoms. And let's go back and look at divergences. So this is the RSI down here, which shows overbought, oversold kind of. So if you're in the middle, it's neutral. If you get outside of the band, you're oversold down here. If you get out of the top, you're overbought up here. Usually the market will kind of reverse directions when you get overextended on this guy. But what I wanted to point out here is that, well, we had like a little mini divergence here, right, where we were going down, 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 and this is going up, 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 right? So that's momentum reversing, and you get a pop, right, which failed. And this never got out of the range up here, but yeah, anyway, this pop failed, and we came down to another low, and you see it's a higher low back here, and then we rolled over again, and it's a higher low again. So we have 3 tap divergences, kind of a longer range on this whole move down. It's been diverging to the upside the whole way down, which is interesting on the general market. And then what were the other ones? Treasuries? Right, treasuries, 3 lower lows, 3 higher highs, right? That looks like treasury. Oh, and they popped. Oh, I didn't realize. Yeah, so treasuries just popped right here. So check this treasury chart out. This inflationary move in the general market, the treasury bonds knew about it the whole time. I mean, they have just been dumping and dumping the whole past 2 years, just preparing for it. And then this monster ripper is exactly what Michael Burry said. He's like, we're going to get an inflationary breakout, and I'm shorting the treasuries, the TLT. Like, he just said that very blatantly. He's 100% correct. And if you're not out of your trade right now, you need to get out today, Michael Burry, because this thing is bottoming. And I don't know, it might go sideways, it might go kind of up, something like that. But I'm calling the bottom on treasuries today, right here. And oh, right, this weekend, or tomorrow, trading day, is triple witching, which means a ton of options are expiring. And that means a bunch of money that was positioned in options is closing out and then has to get repositioned into the market. So the closing tomorrow is semi-important, but where everybody repositions after that is super important. So let's go to the dollar. So I called this peak on the dollar as a top, and I called that just because it's getting far away from the trend line, and it started going a little too vertical, and it's made a higher high here. We can see the DXY is 1, 2, 3 highs in a row, right? And we get 1, 2, 3 lower highs on momentum. That looks like it wants to reverse. And I'm going to call it not holding this line and flagging. I'm calling it all the way back to trend, maybe even poking the trend. But I think we'll continue the strong dollar. So I'm looking at something like breaking down, picking it back up, and then we'll go strong again. That's the idea that I think we're having for the dollar. But this, the dollar coming down, is pretty good for the market, and the treasuries, like as treasuries collapse, the treasury yields go up. So it's related to interest rates, and the high interest rate move is bad, sort of. And now let's get into, I think that, oh, what did high yield do? Yeah, high yield is looking scary still. So this is not looking bullish at all. This needs to break out of the downtrend to get bullish looking. But it is kind of extended away from the downtrend right now. And it could flag or bull for like a couple of months. Anyway, the high yield's not doing a divergence really. I guess maybe this stabbed, not really. But anyway, I wanted to look at it. But this is the big chart that I wanted to explain this video. And this is interest rates. This is the eurodollar futures market, which, I don't know, I call it like the international bond market, but it's really the international interest rates. And it's the repo market, basically. It's the interest rate at which international banks trading dollars, they can trade dollars for US treasuries at this price. So the last peak we had, so downwards is inflationary, it's higher interest rates. It's like this is the last interest rate peak, which was, I think it was 2.5, and the Fed came to the same rate, and then it switched and went back to 0. This area around 100 is 0. And we just had a huge inflationary rip that broke out of the long-term trend. So we've been in this downtrend for the last, 40 or 50 years. and I'll explain. I'll go back and show what's going on. But we have an official inflationary breakout of a 40 or 50-year downtrend right now. And the general idea here is that the market does not like vertical moves, and it loves sideways moves. But the direction of the move matters also, more than just vertical versus sideways. But that's the general idea. And I'm going to go, let's throw the S&P on here. SPX, and it smashed the chart. Hold on. I forget how to do this. I need to put it on a separate scale. Wait, where is it here? Pin, let's see. Pin to new scale. Right? Okay. Okay, so now I should be able to, that's like stuck, hold on. Here's an education in how to sloppily add an indicator. I think I want to pin it to the right. Okay. New right. Yeah? Okay. And I should be able to scale this thing too. Oh, I'm on auto, that's why. And we want to log it. Alright, so let's go. Wait, it's not. Yeah, here, that's what I was trying to do. It wouldn't let me do it. Alright, so we're going to go back to, let's go back to .com bubble, where I'll show what's up. So, movement to the upside is deflationary, and movement to the downside is inflationary. So when you get inflationary moves, that means more dollars in the system and interest rates go up, right? And so I guess just in general, people are saying, the government is saying the CPI, which is price inflation, is at like 8 or something, and people are like, it's not 8, it's like 10 or 20% or something. This is a bunch of nonsense. Price inflation doesn't mean anything. It just means prices changed. Don't use the word inflation for that. That's super annoying. Prices can change regardless of inflation. But this is looking at actual inflation, which is more dollars in the system, less dollars in the system. And the interest rates reflect that. And so this is like the 90s, right? So you can see here this huge sideways area here. The market loved that, right, leading up to 2000. And it starts heading down, right? And the market starts kind of getting volatile and kind of going sideways. Still bulling, right? Still bulling. It bottoms at the normal area where you would expect it to bottom. It's still going sideways, and then the market's like, okay, we're going to start heading down now. And it starts getting scared, right? And the dot-com bubble starts crashing as we're doing the deflationary move. As this moves up, right, deflationary, pulling the market down, and then you see the sideways move, and the market bounces. And boom, more deflationary, down to 0, and bang. We go down to 0, we bottom, right, and then we get sideways stuff. And the market rallies really hard on the sideways stuff, right? And then it starts rolling over, and this is an inflationary move, but it's a gentle one. And you can see the market is kind of bulling, but weakly. It's more sideways than up, right? When the market's going sideways here, when the interest rates are sideways and they're stable, the market loves it. And then the interest rates are sort of stably going up. The market doesn't like it quite as much, but it'll bull when they're going up, right? And this isn't like a crash to the upside. It's just a general normal rate hike. And then you get the sideways part again. Market loves sideways. Ramp right to the top of the financial crisis, the housing bubble, right? And then you get this big deflationary move, boom, and the market starts to freak out, and then it stabilizes, the market starts to rally, and then boom, to 0. This move to 0 is bang, the financial crisis. And then it rallies super hard, as we get to zero, and it stays at zero for freaking ever. For like 8 years, and the market is just bulling like crazy as it's flat sideways for like 8 years, right? And then we start coming down, right? And it's a gentle thing, and the market checks, and it's fine with it. It's still bulling, right? And then we start to drop off of our downtrend, and so we're getting close to the bottoming area where we might reverse into inflation. So the market's like, oh, I don't know if we're going into inflation or not. And so you get this inflationary move, right? And this is Volmageddon. Like, oh crap, are we switching into inflation? The market freaks out. It starts going sideways, no worries, right? And then it threatens to break into an inflationary move. And the market craps itself. And then it's like, oh, never mind. We're flat. We're staying in a deflationary kind of environment like we've been in the last 50 years. Right? And then the market's like, oh, okay, cool, we're all good. We're just kind of going sideways, but it's looking sketchy. Right? And then you get this move, boom, deflationary move back to zero, and the market just freaking crashes. Right? So the big crashes happen when you move down to a key level. I mean, zero is a super key level, right? It doesn't have to move to zero. I mean, like 20 years ago, it would move down, a big move down to 12% would crash it or something. But this move to zero is scary as crap, right? But then we get sideways again. This is the COVID sideways rally, and it's sideways for a year and a half. And I mean, you know what it did the last year and a half? It was ramping and going crazy, right? And then we get this peak. Okay, so this is where we are now. So it started to turn over, and now it's like, well, are we going to get an inflationary break now? It's definitely a big threat. Everyone's been talking about it the whole last year. And the market has been like, yes, we're terrified of an inflationary breakout, but not terrified. It just needs to pull back and figure out where the inflation peak is, right? And so we had sort of a false, I mean, if we were going to hold inside of the downtrend, this is what I was calling, is that we were going to hold here, and the market, I thought, would just run from here. I thought we were just going to run from here. Market, like, interest rates go sideways and it rips, right? But we didn't. We did another second move, right? And so the rally completely failed, and now we're down here, and interest rates are here, right? Okay, so that's the general idea of how interest rates relate to the market and actually where they come from. This is the international bond trading market. The Fed does not control this. It's the repo market. But you do see the Fed intervening in the repo market. Like the Fed's doing a bunch of reverse repo operations right now, which is this inflationary environment kind of stabilization move because, well, as you can see here, I mean, this previous low here, that was like 2.5. So the market interest rates right now is about 3, right? And the Fed just popped the Fed funds rate to like 1.5. It's like a 0.75 raise. So that's only about here. So the Fed's only about here so far, and the market's at like 3, right? And so that's why reverse repo operations are going nuts. I think right now is because the Fed is giving you a better deal than the market is. So the banks can trade for cash at a lower price. They need cash. They trade overnight in the repo market. And the Fed is at a different price than the market right now. And so that's sort of like a little balance sheet hack that the banks can do right now until the Fed catches up. So if this starts going sideways, which is what I'm calling now, my last sideways call was wrong. But if this starts going sideways, like I was just saying, the market will absolutely love that because it loves sideways until it starts going up, right? And then it will start, flattening out. And then when we do this move down to here, that's going to be like another little crash. That'll be like a little mini bear market. But if we crash through there to here, that's going to be a big bear market. And if we crash through there to negative interest rates, that will be like financial crisis way bigger than the financial crisis 2.0. But basically what I'm calling for now is we're switching into higher interest rates. We just did the breakout, and then we need to top test this. We're going to get a little crash when we top test it, and then probably go sideways, right? And then, who knows, like just start doing normal stuff. But it'll be inflationary. We'll go to higher interest rates. We'll go to 3, then we'll go to 5, whatever. That's what I think is happening now. But anyway, that's where we are right now, regardless. And that's how the market responds to the interest rates. And this is where the interest rates actually come from. It's the eurodollar future trading market sets the rates, and then the Fed can kind of play around with it a little bit. And the Fed might be a little behind now, but I mean they're going to do another 0.75 and then another 50, and then they'll be pretty close to where the market is in 2 more rate cycles. But right now, that's, I think, dovish. Where the Fed is nicer than where the market rate is right now. And so I think that's fine. But if the market starts going sideways, whatever the Fed is doing is not that big of a deal. Like if this is the bottom here, which I think it is, you can just see the sort of the downtrend line here. I mean the red line, we're on this downtrend, and then we went back to 0, and then I moved that line. There you go. Yeah, anyway, this is a ton of crap all over the chart, but that's the general idea, is that I think we're bottoming here because that's our resistance line. We broke out of the downtrend and we hit resistance here, and that's the generic call here. You do a breakout, then you top test it. It might be faster than that. I mean, it might not go sideways very long. I mean, we could get just like a month or 2 of sideways. If it just kind of coils here for a minute and then goes back to 0, like this deflationary move will be a crash. Like this pullback was very, very controlled inflationary pullback as we're trying to figure out where the interest rates are going. And the eurodollar future market is definitely not a leading indicator. Like the international bond trading market knows where inflation is and knows where trade is, knows where supply and demand are. And they have been very carefully controlling, figuring out how tight is it getting, like where interest rates going, right? And if this is a bottom, the market is going to love that, and it's going to rally. But if it's short-lived, like it's just when do we crash back to support, which should be here, and then does it hold or not? So that's the next kind of thing. But yeah, anyway, this is a bullish video. Because I think that this is a bottoming area on the interest rates, and this is the actual inflation. The actual inflation is around 3%. So if you think prices are going up by 20%, 3% of that is actual monetary inflation, and the rest of it is supply and demand stuff. And I think supply and demand now is flipping completely upside down because there's way oversupply, and the demand has crashed. Like it's double upside down. And I think interest rates are pausing right here. So we're going to get what looks like a deflationary move coming in the CPI, or the prices are going to come down, I think. But I think we're going to have interest rates stabilize here for an undetermined amount of time. I don't know. So it just depends how long we go sideways. It'll just bull as long as we're going sideways, and then it'll crash when we go back to support. So that is the idea. And yeah, that's it. That's all we need from this chart at this point is like, does it hold here? Probably. And how long do we go sideways? The market will just bull and bull and bull as long as we're going sideways, and then whenever we do that crash back to support, that will be a crash. That'll be a deflationary market crash. And if we crash through there, it'll be a huge deal. So that's, yeah. Anyway, that's the idea. Not investment advice, as always. Forgot to say that in the beginning, but you have it on the intro slide. Yeah, so please smash the like button. Let me know if you want any other charting eurodollar stuff. I don't know anyone that charts eurodollars like this. Let's look at the VIX, because my VIX chart is better than everyone else's also. Let's get the S&P off of here. So Yeah, right. So the VIX, I mean, you can just see what the VIX does. Like it settles and then it pops, right? And then it settles, pops. It usually will pop one level at a time. Boom. In COVID, we popped two levels, right? Now we've popped up. So we're probably, especially if we're going to start bulling, we'll probably settle out into this channel until we get that deflationary move, and then we'll pop again. That's probably what the VIX is going to do right now. And this scary bottom just did another completely generic controlled top right there and just stopped it. And yeah, you can see the downward momentum on the VIX is matching the downward momentum here, which is not divergence. That is total correspondence to the downside, which I think this top is going to hold. This is what I expect the VIX to do in any case. Well, not that. Whoops. Yeah, I think we're going to come down to this level and start coiling in here. And I don't know how long that would happen, but that's my idea on the market right now. Just trying to find the bottom. And as far as the chart goes, let me draw the bull and bear thing on this real quick. Let me zoom out a little so you can see the zones. So, I mean, this is our big megaphone pattern from Volmageddon 2018 COVID, right? And we sort of jumped on top of it, but we broke through it, which is interesting and scary looking, and we're coiling under. But the general idea, if this is a bigger bear market like everyone thinks it is, the bearish idea that I have right now is that we'll probably we do the coil underneath, which means that you want to break this line, but you're probably not going to do it yet. Like you need to go test the other side, and then you can break it, right? So it's just a question of what's the other side, which right now, if it's a bear market, you're looking at rallying to this area, right? And then you can go break it. That's the bear market continuation. And you can see the general kind of bear market topping downtrend idea here. That would be the bear market idea is you stick underneath. You see how we went underneath the blue line twice here? That was a bear market continuation to the downside there. And that's what I would call, for a bear market continuation, I would call the same thing. Double rejection off of here and then continuation to the downside. And we've coiled under, so you may as well just break it, right? That's a bear market continuation kind of pattern. And the bear market pattern, I think we still rally. And we might rally, we might get sideways on the eurodollar futures just for like 1 month and then coil a month and a half, 2 months, something like that. And then you get that deflationary move back down to top check the channel, and then you have a follow through dump. And then we got to figure out what's doing from there. But yeah, that's a little rally and then a crash, kind of bear market continuation. If we get a longer bullish pattern on the interest rates, the bullish thing that you want to look for on the chart is to jump on top. It's called a higher floor, right? You pick up support and then you just start jumping on top, and then you start running into, a bunch of resistance. If you got all the way up here, you'd be running into a ton of resistance around here. That's just kind of a inflationary bullish thing. Not that it's going to do like 8 bull flags like that. But anyway, that's kind of the zone we're in. And yeah, we could do both, really. I mean, we could do a big route. The super dramatic thing that I drew a few times is we rally up to here, and then we crash back down to here, and then we go for a bit like megaphone, a big megaphone pattern. Now that we've done an inflationary breakout, I don't know that we're gonna. I don't think we're gonna crash way down here like that. Yeah. Anyway, just bullish for now. Bullish for now until until it makes sense not to be. Let's zoom in a little closer on this thing and look at it. What are we doing? So we threw a tail through here. Okay, so just looking at this down move, it's very controlled and it's really symmetrical, and it's actually an Elliott 5 wave, right? That's like a 1, 2, 3, 4, 5, which is a leading pattern that's more bearish. Like if it was just an ABC correction here and then this broke out, then so yeah, I'm not really sold on all-time highs here, especially since we coiled under here. But I think we're gonna rally now. I think we're gonna rally now, at least to this red line, and then we'll have to take another look at what's going on. But yeah, but anyway, you can see the downtrend, right? And then you break out, and then you jump on top of where you broke out from, right? And then we've painted a steeper downtrend. Then you break out, and now you jump on top, and then this downtrend is pretty much vertical. I think if we break out of that downtrend, I don't think we can like do another vertical jump on top of it. I think this is probably the last one. I think on the S&P, this is probably the low here. Right, and we have tons of options expiring tomorrow. And we have interest rates probably stabilizing here. We have a bunch of divergence, all the stuff that I just pointed at. And I think it's a short week next week also. But yeah, I think the option expiration is happening tomorrow, and that's a big deal. And then I guess I could talk about the max pain. The max pain is the area where the market has to pay off the fewest option contracts, right? Right now we're in the money on a ton of puts. Like there's a bunch of puts at like 4,000. And so for the market to not pay all those puts off, it wants to get to 4,000 by tomorrow, which would not surprise me at all if the market just throws a huge green candle and all those puts expire worthless, and then it can do whatever it wants after that. But that kind of theory works well when you're going sideways, but it doesn't necessarily pan out when you're making a move. But anyway, that's where the max pain for the market, where nobody gets paid on their options. Like there's not very many calls, and they're like up here, and there's a bunch of puts like all in here. And so in order to not pay anyone, the market wants to get in here where it's not paying the calls or the puts. There's just like a tiny amount of calls and puts in between. You can look up the options chains and see where all the calls and puts are. But in general, that's where they are this week, and this is a huge options expiration. So yeah, if it closes down here, it'll pay some puts out. And if it closes up here, it'll pretty much screw everyone who's expiring this week. So anyway, that's the max pain idea, which you'll see like when you're flagging sideways doing this stuff, like it will just move to the spot that screws the most people all the time. But when you're making a big move, like people get paid on their option trades. So that's the idea. And you know, like this move sideways was just long enough for a bunch of options to expire, and then it moved. So that's kind of what the market likes to do, is just move away from everybody's moves. Let's look at the put call. Let's see how, because we had a flood of calls that came in. Yeah, like right here. After this move up, we had a bunch of calls that came in, right? And then the market just moves away from them. And now I bet a bunch of puts have come in, and the market is just going to move away from both of them and just screw everyone. That's probably what's going to happen. All right, so PC, not OPC, PC, put call. Yeah. Oh, we actually went to the negative side as of yesterday. So these are call option peaks here that I have circled, and these are the last three tops on the market. This was the February top, the November top, like a bunch of crappy small stocks blew off here, and then a lot of stuff peaked in November and started to blow off. We had that rally in March that blew off April here. So these call peaks are tops in the market, and now, not saying that, look, it's like jumped out onto an island. We have a giant pile of puts that just came in, and it's like a gap in a pile of puts. Um, and this is the first time we've been in puts since COVID. The last time we went on this side of the line was COVID. And prior to that, it likes to kind of stay around even, but yeah, it usually will just kind of wobble around even as people just kind of trade the market back and forth. But you can see it was like at a call area and it ripped to a put area, and all the puts got screwed on the COVID crash. It ripped out of there, and we just did it again. And so I don't know, I mean, you can see how many weeks, it was like a month of puts being high before it ripped the other direction. But yeah, anyway, we just went to weighted on puts. So you can't really tell where the extreme is. I mean, we could keep going down and keep getting more puts and more puts. At some point, the puts will be at an extreme and they'll get screwed, but not necessarily like tomorrow. But in any case, it is going put heavy again because that rally we got another call peak on that little rally, that little bear trap rally that we had last week. Um, yeah, so that's the idea. And yeah, and those are the stocks that I think are going to move, the ones I was just talking about. Like GameStop looks pretty good, Workhorse looks pretty good, Aqua Metals, maybe. Um, and then I just have a feeling that silver is going to start running. It's just, I mean, it ran off COVID pretty good, and silver's just done a bear flag for like a year and a half. Or not a bear flag, like a bull flag kind of consolidation down. And just like this silver chart, let me go find silver. Where's silver? This is AG. Silver miners is just at a long-term support. And if you look at silver, it's just doing pretty much just looks like a bull flag. And all it needs to do is, it rips, bull flag, and it rips, right? It'll usually break out and top check it, and then it'll go. That's just kind of the bull flag thing. But yes, silver looks like a bull flag to me. And gold is holding up. I mean, gold versus dollars has been pretty well sideways for a couple of years. It's not very interesting right now. But gold is holding up, which is good for silver. And then usually look at copper, which is actually not holding up that well. Copper is like on a flat top. This looks actually pretty dangerous for copper. And that might not be a great indicator for silver. But we'll see. We'll see how copper handles the next couple of weeks of trading. But anyway, I'm taking a stab at silver on the long side. Yesterday, I think I bought them. And yeah, that's the idea. GameStop's been an early mover. So I was thinking, like, if we get a bullish run and GameStop moves early, I might close all my GameStop out and then try to find, like, close GameStop and then try to find this thing at support and maybe try to do the short squeeze play on this. The red box is the next meme nonsense that looks like it's coming in. This is so ridiculous. Okay, that's very long-winded. So happy trading, and I'll see you next time.